Hi everyone, welcome to chapter 11. Sorry it's taken me so long to get this example for you. Last chapter, I hope you're excited. You guys are doing great, keep it up. I just want to run through some examples. So this chapter talks about different ways to determine whether to take on a capital project or not. So capital budgeting. And I want to start with M11.3. The accounting rate of return. That's one method. So the accounting rate of return is calculated by taking the annual net operating income divided by the initial investment. Now, on these problems, be sure that you read everything carefully because it's asking for an annual net operating income, not cash flow. Some of the formulas ask for cash flow. So annual net operating income. So this is supposed to return $390,000 over 3 years, and it costs $920,000. But we want the annual net operating income, or income, not the 3 years. So we're going to take the $390,000 and divide it by 3. Gives us an annual. The initial investment is $920,000. The accounting rate of return is simply taking the annual net operating income and dividing by the initial investment. And it's 14.13%. And then there's the payback period. This is another way to evaluate whether you're going to take a project or not and do capital budgeting. So the payback period formula is to take the initial investment divided by the annual cash flow, not annual net income. So cash flow is net income plus depreciation. So we have to be careful here. But they've given you the cash flow, so they didn't give you the income. So we don't have to do any extra calculations. I just want to make sure that you get this straight because this can actually hurt you if you don't read carefully. So the initial investment is $340,000. The annual cash flow is $80,000. We pay back our initial investment in a number of years. How many years? Well, we take our initial investment and divide it by our annual cash flow, and we come up with 4.25 years. Note that this only works if the annual cash flow is the same every year. If it's not the same every year, you have to do some calculations to figure out exactly when it gets paid off. So you'll typically apply a portion you'll subtract the annual cash flow from the initial investment for each year until you get down to paying it back. And in the last subtraction, you have a partial year. And then there's the, we're going to go do these again, accounting rate of return and payback period. So Blue Marlin is considering purchasing new equipment. This is one way that we use these things. It will cost $250,000 and have a $50,000 salvage value in 5 years. That means when you're finished with it, you can still get $50,000 out of it. The annual net income is expected to be $25,000 and depreciation is $40,000 per year. So first do the accounting rate of return. So we take our annual net operating income, which is $25,000, and we divide it by our initial investment of $250,000. And we come up with a rate. And that rate is 10%. And you'll notice this method totally ignores that you can get $50,000 back at the end. So the payback period, how long will it take you to get it paid back? The initial investment is $250,000. The annual cash flow, not net income. So cash flow, net income is $25,000, but depreciation is $40,000 a year, and we know that depreciation is a non-cash item. So we have to take our $25,000 and add our depreciation back because we've subtracted it to arrive at net income, and come up with an annual cash flow of $65,000. We divide the initial investment by the cash flow per year, and we come up with 3.85 years. And again, in this method, we're also ignoring everything we receive after it's paid back, including the salvage value at the end. So you can see there's some problems with these two methods. They're very simple, very quick. A lot of companies use these to do a quick sweep of projects to determine if they're even going to be evaluated. So this is like a first step. The best method is to calculate the net present value. If you don't have any experience with present value concepts, you can look in the textbook, and there's, oops, hold on. Let me see if I can get this. There's a supplement 11A, and I'm going to pull this over here in a second. Supplement 11A in your textbook talks about the time value of money. Money does have a time value. The time value of money is interest. So keep that in mind, and if you're unfamiliar with time value of money concepts, then you will want to take a look at that supplement and work through some of the problems. So in this one, Citrus Company, sorry, I'm having some computer issues here. Citrus Company is considering a project that has an estimated annual net cash flow of $32,000 for 6 years, and it's estimated to cost $150,000. Their cost of capital is 8%, or their hurdle rate, or whatever you want to call that. You're asked to calculate the net present value of the project and whether it's acceptable to Citrus. So in year 0, when we start the project, we have an annual cash flow of minus $150,000. Oops, sorry, I got carried away with my zeros there. So $150,000 out the door on day 1. There's no present value to calculate because it is at present value. So the present value of $150,000 today is $150,000. There's no interest to take into account. Now to do these and to do them on the exam and in the examples and in the practice and the homework and everything, you will want to use the present value tables. They're in the supplement. So if you go into the supplement in the textbook and you go to page 5, well, let me just go through these first. We're going to use tables. And I am aware that you can do present value calculations in Excel, but you will come up with a different number than you will for the tables. And the tables are very simple to use. There are 4 tables. You will only ever use one of them. There's future value of $1. We don't want to do that. There's present value of $1. Well, we may look at that in a later problem. But this means what's the present value of a single amount sometime in the future? $1 in the future has a present value of what today? And there is a formula here, but these tables give you factors that you can use. And then there's future value of an annuity. An annuity is simply a series of payments, but we're not going to do any future values. And then there's present value of an annuity. This is the table that we'll use for a series of payments. So looking back over here, we actually have years 1 through 6. We have an annual inflow cash of $32,000. What's the present value of that $32,000 given a cost of capital of 8%? So we look at the tables. I'm going to kind of make this smaller. Bear with me a second. So we look at the tables. We look at the present value of an annuity because it's a series of payments. It's $32,000 a year for 6 years. We look at 8%, so we find 8% up here. We follow it down to 6 periods. So 8%, 6 periods. The factor is 4.6229. So 4.6229. And we just multiply those. That gives us a present value of $147,932.80. We put these two, net these two numbers, and this gives us a negative net present value. This means that it's not returning 8%. If 8% is our cost of capital and our hurdle rate, then we would turn down this project because it's not returning 8%. It's returning something less than 8% because it's $2,000 negative net present value. Let's do another one. On this one, we're asked to calculate and evaluate the net present value of this project. So we've got initial investment of $400,000, annual cash flow of $70,000, expected life 10 years, cost of capital 11%. So we're just going to do the same thing we did in the other one. Year 0, annual cash flow. So this is the cost initial investment minus $400,000. There's no present value factor here because we are at year 0, which is present value. So $400,000. Expected life is 10 years and annual cash inflow is $70,000. So years 1 through 10 is a positive $70,000 each year. We need to find the present value factor for that. So we're going to use cost of capital 11%, and we're still going to use the present value of an annuity table because it's a series of payments. So we go to 11% cost of capital, and 11%, and we go down to 10 years. And we come up with 5.8892 for a factor. 5.8892. Multiply those, 70,000 times 5.8892, and we come up with 412,244. Net these two, and we come up with a positive net present value. And then it tells us, without any calculations, explain whether the internal rate of return on this project is more or less than 11%. Well, if the net present value is positive at 11%, then it's got to be more than 11%. And we can kind of illustrate this by doing one, this was at 11%. Let's do one at 12%. So we have this same information here. So I'm just going to copy this over. Oops. Let's copy this over. 400,000. We need a new factor because now we're at 12%. So we'll do 12% for 10 years. The factor is 5.6502. Multiply that and add them together. Now our net present value is negative, meaning that it's returning less than 12%, but more than 11%. So someplace between 11 and 12% is what it's returning. If it's positive, it's more than the factor you used, or more than the percentage you used. If net present value is 0 at 11%, that means it's returning exactly 11%. All right, let's move on. So we're going to calculate a project using the accounting rate of return, the payback period, the net present value, and then recalculate net present value at 15%. And then based on those calculations of net present value, we're going to estimate the project's internal rate of return. All right, let's start on this. So the accounting rate of return is the annual net operating income, not cash flow. So the annual net income, 20,000. Initial investment was 200,000. So our accounting rate of return is the annual net operating income divided by the initial investment, or 10%. The payback period. Well, first we have to calculate its annual cash flow, or initial investment divided by annual cash flow. So we first have to calculate annual cash flow. Our annual cash flow is the net income plus depreciation, but you're going to have to calculate your depreciation. Your depreciation is equal to your cost, 200,000, minus your salvage value of 12,000, divided by the life of 5 years, the useful life. So my annual depreciation is 37,600. To get annual cash flow, I'm going to take my annual net operating income and I'm going to add my depreciation. So this is my annual cash flow. My initial investment, 200,000. My annual cash flow that I calculated. My payback period is the initial investment divided by the annual cash flow. 3.47 years. Their cost of capital is at 9%, and it also, excuse me, asked us to calculate it at 15%. So, year 0, that's where we put the cost of the project, which was 200,000. So minus 200,000 out the door on day 1. Don't need a present value factor because it already is at present value. It's at year 0. Cash flow years 1 through 5. 1 through 5, is 57,600. But we also have something else going on at the end. We have a salvage value. So we can get $12,000 at the end. So in year 5, we can get $12,000. Let me make this formatting the same. Okay. So we can get $12,000 at the end. So we have 2 present value factors to find. One for a series of payments and one for one payment at the end of 5 years. So let's do the series first. 9%, because that's what they said our cost of capital was, 9%. So we'll use 9%. We'll use the annuity table because it's a series of payments. And we'll find 9%. And we'll follow it down to 5 years, and our factor is 3.8897. And we'll multiply those two things. So the present value of $57,600 per year with a rate of 9% is $224,000. Put that a different way. Well, let's not get into that. I don't want to complicate things. So, what's the present value of $12,000 5 years from now with a rate of 9%? Go to our tables. Remember, this is an annuity, so it's not a series of payments that we're trying to get the present value of, but it's the present value of 1. So we go find the present value of 1 table here. And we look for 9% and 5 years. So 9%, 5 years. 0.6499. So the factor is 0.6499. Multiply. And then add these 3 things. Net them against the negative 2,000. Gives us a net present value of $31,845.52. So we're making well over 9% here, right? Because at 9%, net present value would be 0. All right, what about at 15%? So we're going to use these same numbers here. Let's not cut it, let's copy it. So we're going to use these same numbers. There's no present value of 200,000 because we are at present day, so it's negative 200,000 cash outflow. Now we need to look at our tables. We need to look for the factor for these at 15%. Since we're already on this table, let's do this one first. So 5 years at 15%, what's the factor? So we're going to go, we're on the present value of 1 table. So we're going to go 15%, and we're going to go down to 5 years, and the factor is 0.4972. And we'll multiply those. Okay. Now let's do this one. So this is an annuity because it's a $57,600 each year for 5 years. So at 15%, we need to go to the present value of an annuity tables. Present value of an annuity, which means a series of payments. And we'll go 15%, and we'll go down to 5 years. And the factor is 3.3522. 3.3522. And we'll multiply. And then we'll net all of these together. negative net present value. So at 0, if this were 0 at 15%, that means our internal rate of return would be 15%. The question says, based on these calculations, what do you estimate the project's internal rate of return to be? Well, it's not 9%, it's closer to 15%. Maybe it's 14% or 14.5%. We could keep working this and figure it out and extrapolate between the two on the tables. And you can actually find some tables that are in 0.5% online, but don't worry about that. It's just a generalization. So just know that if net present value is negative, it's not returning whatever percentage you use to pull the factor. But this is pretty close. I would guess it's going to be 14 point something. It's way over 9. It's over 10, probably over 12. You could calculate each one and see how close it was to 0. So when the net present value is 0, whatever factor you use to discount is the internal rate of return. So let's just say it's closer to 15%. Maybe 14.5. We don't know, and we're not asked to calculate this. We're just asked to estimate it. And that's our educated estimate. All right, I hope this helps. Have a good week. Post in the discussion.